Hey, this is Chris. Now with tech stocks down big time this year, a common question we're getting from clients is, should I be buying tech stocks now? Now, so far this year or over the last year or so, Facebook or Meta is down 70%, Netflix is down 60%, Tesla 50%, Google's down 40%, Microsoft down 30%, and Apple's down 20%. So all of the big tech companies are on sale at the moment, and for those that have watched my videos before, you might be a little bit surprised by my answer because I'm always talking about the benefit of dollar cost averaging and buying cheaper where you can. That's great when it comes to broad asset classes, but unfortunately it doesn't work when it comes to individual shares. So my advice is actually not to be buying the dip on these tech shares, and to really give you a better understanding of why I wanted to share a bit of a historical example. So tech shares went through a similar sort of crisis in the early 2000s. There was a similar sort of boom in the late 90s, and then that kind of flipped in the early 2000s, and tech shares fell by a similar quantum to what we're seeing today, if not a little bit more. A lot of companies that are great companies now today and were great companies then fell by up to 90% in that period, and some of them by even more. So Amazon, fantastic example, it fell by 95% after the tech wreck. So if you're considering buying a company that's down 70% today, the problem is that it could still fall by 70% again, and only get to the point that it did after the last tech wreck. And to kind of give you a bit of a worked example, if a share price is 100 and it falls by 70%, it's down to 30. And then if that $30 share falls by 70% again, it's down to 9. And that's down 90% in total. So I think a lot of people make the mistake of seeing tech shares on sale and think, well, Tesla's down 50%, it can't possibly fall anymore. The saying I've heard before, which I like, is that a share that's down 90% was a share that was down 80% before it halved again. And unfortunately, you can still lose a lot of money buying shares that are down 60 or 70 or 80% because they can halve again. So my advice around dollar cost averaging is that it is fantastic with broad asset classes because you're diversified. And that's really important at the moment. You don't want to have a lot of your money in one sector of the economy. Tech's a wonderful example because it's done so well in the last 10 years. Backed by low interest rates and low inflation. But in a world with high interest rates and high inflation, tech could be one of the worst places to be over the next 5 or 10 years. And that's definitely what we saw after the original 2000s tech boom and bust. It actually took 16 years for the NASDAQ, which is the big tech index in the US, to catch up to where it was in 2000. And it took until 2016 to get back there. So if you are buying some of these tech shares on a discount, you could be in for a very long wait to make up your money. And so you could be buying the dip prematurely, which is why I think don't bother trying to buy the dip on individual shares. It may sound tempting and it may sound like you're getting a great deal and you can brag to your friends that you've bought Tesla down 50%, but it could be a long grind backwards, and you might miss out on other sectors that might be the leaders for the next 5 or 10 years. So who knows what they could be? I don't profess to know, and I think a lot of others don't know either, but it could be energy, it could be resources, it could be banks, it could be any one of a number of sectors that actually leads the market over the next 5 or 10 years. That's why you need to diversify. Don't buy individual stocks. Spread your money across different countries, different sectors, different asset classes, and do not be tempted to buy tech stocks on sale. You may get it right sometimes, but just as often you'll be waiting a decade to make your money back.